Hey, welcome back, everyone. We're super excited today to be chatting with Russell Marsan from IPX 1031. And there's been so much conversation in regards to really what is a 1031. So I thought we would invite Russell in here to chat about that a little bit. And Russell, thank you. Welcome. Appreciate you being here.
Well, thanks, Eric. It's a pleasure being here.
Yep. And how long have you been in doing the 1031 business?
Oh, a long time, 28 years.
Yeah. So yeah, I've been doing 30 years in real estate. So I figured, hey, let's match up. This would be great. So Russell, why don't you explain a little bit about what a 1031 tax exchange is to some people that may not know what that means?
Yeah, actually, a 1031 exchange is really the greatest wealth building tool in the entire Internal Revenue Code because it allows real estate investors to kind of reposition their assets throughout the course of their entire life without having to pay tax. Because if you invest in real estate or anything, actually, as you grow in life, your financial objectives change. You're young, so you're trying to build wealth. You don't have any. Later on in life, maybe you've built equity, you've built wealth. Well, now you want to go into a better cash flow position or you want to go passive, right? Those are all different types of objectives. So the 1031 allows you to pivot, right? Sell an asset that's no longer providing you with the financial objectives you prefer and allow you to buy something else that does. So you can always continue to make sure that your portfolio is meeting whatever your current financial objectives are. And you get to do that throughout the course of your entire life without having to pay taxes, especially California, right? We're the heaviest tax state in the country. I mean, you're talking about an average of around 35% in taxes every time you sell a piece of investment real estate. So the 1031 allows you to move that 35% with you every single time. So you have more cash flow, more equity, more growth on your portfolio.
Good. So let's go into an example here. I recently, this week, I had a gentleman that called me. He has an asset here locally. He's moved out of state and he called and says, look, I don't know really what to do. I kind of looking to sell. And then I shared with him this surprise $35,000 potential tax hit. And he wasn't really aware that it would be that much. So he's looking at maybe moving that asset closer to where he's at. How does that look in your terms of how to go about that and the time frames that he needs to identify properties and make that work, please?
Yeah, in a 1031 exchange, you are restricted to time frames. So from the close of escrow of the property that's being sold, we call that the relinquished property. From that closing date, you've only got 45 days to identify and 180 days to actually close. Those are concurrent time frames. Now, those periods start when the closing actually happens of the relinquished property. We have to start the exchange. We have to open the exchange prior to closing, right? You can't call me after closing and say, Russell, I'm ready to do an exchange. I've got my check right here. But we have to open it sometime before closing. And those are strict time periods. They're actually calendar days. They're not business days. So if one of those deadlines falls on a weekend or a holiday, then it's that date. The 45th day, that identification period, is the #1 killer of exchanges. So a client shouldn't wait until they close escrow to begin the process looking for properties and writing offers with you and trying to get into contract. You should actually be in contract on a replacement property prior to closing your relinquished property, just to help safeguard your exchange so you're not flirting with those 45 days.
And that brings me back to something too that they need to realize and understand that I like that getting your property in escrow, but then you actually have to open up two different escrows because that money that's coming from that asset cannot go into the personal account. Because if it does, then that I'm assuming just kind of ruins everything, right? It's
Yeah,
yeah.
yeah. As soon as they have control of funds, even if they don't touch the money, even if they have the ability to touch the money, they don't have an exchange. So what happens is, to visualize it, what happens is we actually assign into escrow on the relinquished property closing as the seller on behalf of the taxpayer. And so what that does is that gives escrow instructions to wire the funds to us when it closes. We create a segregated commercial bank account that we name the client on also as well. And so that money just sit there static in that account waiting for them to buy their replacement property. And then same thing, we wire into the replacement property closing when that's due to close.
I had somebody the other day that was actually about a year ago that called me and said, I've got this piece of land. They've had it for many, many years and they want to transfer that. Can they do a 1031? And that person was thinking, well, do I have to buy another piece of land to like for like? Explain a little bit about maybe some options if somebody has one piece of property and what they can maybe go into on the other side.
Yeah, I am so glad you brought that up, Eric, because that is the greatest misconception in all of 1031. This term like kind is actually really misleading. It's much broader than it sounds. A lot of people think, well, like kind means visually it has to be the same. So if I'm selling land, I have to buy land. If I'm selling a house, I have to buy a house. It's not the case. All real estate's like kind with all real estate, so long as it's held for business or investment purposes. So it's not what a property looks like that makes it like kind, it's how it's treated. Any business or investment properties like kind. So yes, you can sell raw land and you can exchange into improved property like a rental house, a duplex, commercial, industrial, any other type of business or investment property. And that's really powerful because, a lot of people out there own 1, 2, 3, 4, 5 acre piece of land. It's not providing with income. They can't take any depreciation. So it's really just this negative cash flow vehicle. The value of it, let's say it's worth $300,000. Well, that's $300,000 of what we call in the financial world stagnant equity, right? That's providing no financial benefits. So you can take the equity, sell the property, buy an improved property like a rental house. Now you own a rental. Now you have cash flow. Now you have depreciation that shelters the income tax due on the income from that asset. In a lot of cases, you have a faster appreciating asset. But that's the beauty of the 1031, right? Because there's many different types of asset classes. And the like kind allows you to pivot, right, to those different types of asset classes that better suit your current financial objectives.
No, I love that. And I know some people also would get a little bit some intriguing sometimes. It depends on where you're going. If somebody's coming from the Bay Area coming up this direction and they're selling a $2 million building and they got to throw their money into different places. Other people, though, might be going from selling something here and going that direction. And now all of a sudden they maybe have extra money. So if you sell $1 million property and you're only going to buy an 800,000, you got 200. I guess the choice then is either pay on that $200,000, or, and I know we're going to share this in another video, but give them a brief snippet because we're going to close up here and we're going to get into the other topic. But where else could they actually put that money in a different direction if it doesn't match perfectly on the exchange?
Yeah, and you bring up that whole equal or greater point, right? Because a lot of people have this misconception about, oh, I just have to reinvest the gain or the profit, right? I get my basis back. And that's not the case. You do have to buy for equal or greater value of what you sold for, minus those one-time closing costs like commissions, title and escrow fees and whatnot. So yeah, if you sell for $1,900,000 at that equal or greater mark, and you only buy something for $7 million, that difference is going to be taxable. So you're correct. You have really just two options. One is pay the tax, or the other is to buy something else with the 200,000. So you could buy a piece of land, small condo somewhere. You can buy an interest in a piece of property. And there's the Delaware Statutory Trust, which I think you were hinting at, that kind of to act as a sponge to absorb the excess boot, you can invest in something. So yeah, there are plenty of options out there to not have to pay that boot if you don't want to.
Perfect. All right, Russell, thank you so very much for hanging out and chatting that, giving that little brief description. We are going to jump on another event, which Russell just shared a little bit about what other options you can do to put your money somewhere else without paying taxes. So guys, look for that second video because we're going to get dive a little deeper into some other details. So thank you so much, Russell. Appreciate you being here. Thank you.
My pleasure, Eric. Thanks for having me.